So thank you everybody for joining. Some have been to all the sessions to date, and some are just new to the process. So just a quick overview of how this is going to progress. And for those that do not know me, I'm Kenda McKenzie. I am the general manager for Halifax Water. And we have a number of staff in attendance today that are here to support the conversation on the regional development charge update overall, but mostly focusing today on financial assumptions and then how the charge is created. So we combined workshop 3 and workshop 4 into one afternoon. Lots to talk about. And Megan's kind of leading the charge and keeping us on track and everything and on schedule. So as different staff jump on, they'll introduce themselves and what they're bringing to the conversation. So I guess next slide. So today we have our agenda. There's going to be a bit of a follow-up from the last couple of workshops. Review of the financial assumptions that go into the RDC model, looking at the infrastructure list and the usage framework, escalation factors, inflation and infrastructure, construction period interest, inflation RDC rate charge, timing of the charge, and some examples of calculations. So it's a bit of a full agenda with a number of topics that we want to bring forward for conversation, discussion, debate, and get some thoughts and opinions. So I'll be monitoring for raised hands in case Megan can't see them, and we can pause, but we also have dedicated time after certain slides to reflect on what we just talked about. So we've been keeping kind of a parking lot, so to speak, of some of the follow-ups from some previous workshops. So workshop number 1 was focused on population projections, reviewing, we're going to be following up on the numbers from 2021 to 2024, and also following up on the people per unit to date, and we'll get more information on that. And then workshop 2 was looking at the infrastructure list and the right sizing and revisiting the current projects. And I don't believe that infrastructure list is available yet for sharing, but as soon as it is, we'll make sure that it's in everybody's hands. And for those that are new to this process or this engagement, we do have our website that has the videos from the past workshops available, and then some of the supporting documents that we've been talking about, such as the financial model. That is available online if anybody wants to follow along as some of the conversation progresses, but it's a meaty little spreadsheet. Next slide. And I'm going to turn the floor over to Fabio, who's going to walk through some of the details of the financial model that we're here to talk about. So away you go.
All right. Thank you so much, Kenda. Yeah, I'll just add a couple. So I'm Fabio Alonso. I'm the finance manager for Halifax Water. And I'm just going to add a couple of points here for the new people that are joining us. The meeting is being recorded and it's going to be posted on our website, right? So, and you're going to have a pause for discussion button. When you see on the slide with that pause for discussion, we're going to stop. We're going to ask questions. You're open to share your comments, your ideas. Just use that hand function availability on Teams as well, right? And when we finish this presentation, we're going to give a short break, and we're going to go to slide number or the workshop number 4, right? But just keeping those rules available to people that are new to the process. So financial model, that's a very exciting topic to discuss. So I'm just going to give a bit of a background for the model. So with the approval of the RDC in 2014, the board directed Halifax Water to update the RDC every 5 years, unless there was any change that resulted in plus or minus 15% of the rate. So if that would occur, then we would do the updates earlier. The RDC was revised in 2019. That's the matter 9494. And we had the 15% trigger in June 2024 when we included the water supply enhancement project. So aside from that, the rates are frozen until October 2025 as the result of the amendments of the HRM charter that the province of Nova Scotia published in late 2023. So we have that trigger frozen, let's say, till October 2025, and we're going to just discuss what we're doing so far. So if you could go to next slide, Megan. All right, so the whole financial model, so we use it to provide the charges for the new constructions. So we're using some non-financial inputs as well, like the population growth, the benefits to existing, and the whole project infrastructure list that we presented in the previous workshops. So those are the non-financial inputs. We also use the 2019 project cost for this project, and we adjust those costs to the current value using some escalation factors that we're going to cover. And the Halifax Water did an exercise with the capital asset team and every project manager, and we updated the cost of the projects that are to be delivered the next few years to reflect the current market conditions. So what we know to date, right, that is most of the projects or some of the projects that we updated using the current estimates. And also we include on this financial model the charges that were collected, the projected inflation, and some financing of cash positions. And of course, the output of this model is the amount for water and wastewaters for single units, multi-units, dwellings, and the ICI per square meter. So those are the outputs that we have from the inputs and the outputs that we have for the financial model. Okay, next slide, please. So just to give you an overview of the whole framework and what I discussed previously here. So we have the 2019 cost that we are using an escalation factor, bringing those costs to 2025, the construction interest, and then we have the RDC cost. We deduct the benefit to existing, we deduct the post-period benefits, and we have the net escalated cost. So what you see on your left side, we have in yellow on the bottom. So that is an example of a few projects that we have. So we're just covering those yellow columns over there. So either we use, and we're looking for the right side, we're looking at the net escalated costs. So it could be either the 2019 cost, or we're using the 2025 costs minus the BT, minus the post-period benefits, and we also have the net escalated costs. So that is pretty much the framework that we are discussing today. You're going to see that the projects, they are grouped in a 5-year increments. So we just group them in every 5 years. So it's easier to make those estimates, and that aligns to the way we're going to present the projects in the future, right? And that's my first part here. I know a little bit, and just giving you guys some time to digest. And if you have some, I see James with his hands up. Go ahead, James.
James, you're on mute.
Yeah.
Still on mute.
Okay, so I'm
There
sorry
we go.
about that.
Good.
No worries.
If you go back one slide, please, to slide number 4. Just want to be completely clear on the second and third bullets here, that any project for which you have updated actual cost estimates as opposed to escalation factors you will be using those updated cost estimates as opposed to escalation factors. Is that the case?
That's correct. Yes.
Okay, you're on mute now as well, Fabio. But okay, thanks.
Sorry.
At
No,
least
I
I'm
No,
sorry.
we can hear him.
Yeah, now I can
yeah.
hear you. Sorry. The other question I have is on the last bullet, the model outputs. I believe in the last RDC decision, Halifax Water was directed to come up with a new approach for the ICI.
Correct.
Is that happening? Where is that? Will there
That's the
be
second
involvement
part of
in
this
that?
workshop, James.
I'm sorry?
Second part of this workshop.
Okay,
It's
sorry.
coming in
Thank
about
you.
an hour.
Yeah.
Thank you. I'm sorry.
Yeah.
No,
No,
thank
it's
you so
all
much.
good.
Yes. Anyone else would like to discuss something on slide number 5? I see James still has his hand up. Thank you. All right, I guess we can move to next slide. All right, so for the escalation factor that we mentioned, so one of the ways of using it is to bring that 2019 cost to this new 5-year future timeframe. We're maintaining the same methodology that we used during the previous matter 9494. We're just updating that to a present date. And the escalation factor is comprised of 2 indexes there. So the annual escalation on infrastructure for the average of 5 years. The original data source is the Statistics Canada non-residential construction, but we have another data source, which is also from Statistics Canada, the Building Construction Price Index, and we're going to show that a little later. And also the annual inflation on RDC, which is the CPI. That is not something hard to explain. If you could go to the next slide, please. So what happens with this inflation on infrastructure? So we're just trying to propose a new index because that Statistics Canada non-residential construction tab or table was archived in November 2022 and has not been updated since. So we're not able to use that again or for this update. But Stats Canada still has or created a new data source, which is the Building Construction Price Index, that replaces that older one. So the idea here is to use the same methodology as we had in 9494, which is the average of the 20-year Canada and 20-year Halifax, combine it, the average of the last 5 years of Canada and Halifax, and have the average of the averages, right? That is the approach that we used for the capital cost contribution, and it was approved by the board. So that is one thing that we changed, that we need to change and discuss soon, because the original index that we used is no longer available. Okay, so if you could go to next slide. Thank you so much. So just to replace that index, we have this new data source. Of course, we have on this slide the link. When you go directly to the table and you see, and I'm going to show some example of what it looks like. This new index starts in Q2 of 2022, and we can do a couple of filters using that index from StatScan. So we can get the percentage changes year over year. So that is similar to what we used in the past. We can filter by non-residential buildings, just like in the past. And we can also filter by Halifax only, or what they call the 11 census metropolitan areas, just like we had Canada before. So methodology would be the same. It's just a different index that we are going to use or going to need here. So, but the whole methodology and the filters we're using are pretty much the same as the previous matter. if you could go to next slide, I'm going to show how does that look like. And I'm going to give you some time to look at that. But if you can see on your left here, you can select geography, just Halifax, or you just select all the 11 metropolitan areas. So that is one thing that we used before. And type of beauty, we can select the non-residential beauties, and you have a quarterly index that we can just use to calculate the new escalation factors. What we have is, if that is, so a question to pose to you guys is, if that is a good indicator, a good index that we can use, or if you have another publicly available index that we could use to monitor the construction costs. And we used to have a 20-year average and a 5-year average combined, a blend of those two. You see that this new index right now starts in 2022. So we might need to get the old index up to 2022 quarter two, and then using the new index from then on, if you're using the same 20 years average. So it's going to be a mix just because of that. Just because they removed the index, they're not updating that anymore. So that is what it looks like. So that is a proposal to switch from the previous index to this current one from StatScan. And we're open to listen to other proposals that you might have. Something that is available publicly, and if we can keep a track of the last 20 years. What do you think about this? I see no hands yet, but I think that the main point is we're using the same methodology. We're just looking at Halifax, whole Canada, and no residential beauty. So it's pretty much an identical approach as before. It's just a new table that we're following and keeping track. So, and one thing that's important to say, all those financial models, the financial models is going to be shared in the future. It's the same that we have in the past. You've seen it before, and everything's going to be explicit there to verify.
It looks like we have a question from James.
Yeah.
Just a quick one. Can you remind us of the rationale for the 20-year historic average as opposed to something perhaps somewhat less, particularly since there's a new index from 2022?
Yeah, so that is the 20-year was the original approved by the board. And I think that is open for discussion. If we use the last, I think the country has changed a lot in the last 20 years. We might be able to use a different average. So we use 20 years and a 5 years average, just making a blend of the two. But that was the proposal back from the CCC and approved by the boards.
If I can just have a quick follow-up, are you rethinking that, given what you just said, Fabio, about the significant changes over this 20-year period, or because it was approved in 2014 or 19, you want to stick with it? I mean, as you say, a lot has changed, and I wonder if a shorter period would be more likely representative of the future. I'm just asking. I don't have a strong opinion about it, but
yeah, and neither do we. So we're still evaluating and make a comparison of those changes, the 20-year, or if we decrease that time frame. So it is just an open discussion right now, James. We don't have that study to compare 20-year, 10, 5, what is the most appropriate. But we certainly know that world has changed a lot and will soon change even more in terms of recent costs or tariffs that we might have. So it's open for the whole table here to discuss, and we're looking at how to do. So that is what you used in the past. I can make the changes and make the model flexible enough to capture 20 years, 10 years, 5, or whatever we find it more reliable or more current. Would that answer you?
Yes, glad to hear that you're still thinking about it.
That's not a hard decision. Thank you for the question. Anyone else?
And if there is any follow-up questions after this, feel free to email the RDC 2025 at halifaxwater.ca with those questions. I know we're kind of on the spot with that, but there's always that follow-up portion if it does come to you.
Yeah, thanks for the reminder. And exactly, if you have any other index that you find that is relevant and we can take a look, just forward to that email address that Megan provided. We're going to show the address later as well. And we study those, right? But I think the main point here is just we're using the same methodology. It's just indexes is a bit changed, but using the same methodology. I don't see any other hands up. I guess we could move to the next slide, Megan. Okay. The construction period interest, that is just the interest that we consider during the construction of those projects. We're maintaining the same index that was used in the previous matter 94, just updating to the present dates, right? So it was the Canadian overnight repo rate plus 7.075% risk premium. So just updating that for the last 10 years, that is January 2015 to December 2024, which would give us about 2.44% its construction period interest. So using the same methodology as before, just updating the numbers to the most recent numbers available. Next one. Thank you. Inflation, nothing new here. The CPI was approved by UARB as the annual escalation factor for the CCC and considered appropriate as well for the RDC. So, and the inflation is used mostly to update the RDC cost every April. So if there is not that 15% change, that would change or trigger a new cost update. The prices would be updated by CPI every April. So same thing, it's a blended average of 20 years and 5 years. The 20-year average between the most recent one is like 2.2%. 5 years is 3.49%, which would give us a 2.8% average rate. And you can see on the bottom right of your screen, everything is listed, all the index that we're getting, they'll be provided in the Excel that will go with the presentation. So you have the CPI rates, everyone, thank you. Yeah, the circled CPI tab there. You all can see the numbers we're using and just verify those.
Peter, did you want to jump in with a question on this one, or?
I want to go back to the last page.
Yep.
Just took me a minute to put my hand up. So
Yep.
is this talking about the discount rate that you will be using on it, or are you just talking about the interest rate used for purposes of the calculation on the slide?
That's an interest rate.
Okay.
Not a discount. Yeah.
Okay. Thank you.
You're welcome. Does anyone has something? We can pause here for.
So can you still hear me? It's Peter.
Go ahead.
Yeah, so does this mean that going forward, there would be an automatic increase by 2.844% per year?
That is the calculation. Till now, remember that the rates are frozen till October. So that is just if we were to apply something in April now, that would be the average that we would apply. But rates are frozen till October, so you don't want to apply right now.
But going forward, whatever the rate ends up, if it was approved, you're saying that it would have a 2.844%
We would
add
have a CPI index to that.
comp,
That's correct. Yeah,
compounded annually.
correct. Yeah.
Okay.
All right. If you could move to the next. Oh, someone. Just a sec. We have Kevin.
Hi. I think the prediction, the escalation you're showing right now is the prediction for the calculation of the charge, as opposed to the charge is annually escalated by CPI, regardless of what you predict it to be.
That's not gonna be applied right now. You're right.
No, but
Just-
what you're showing here is just you're predicting in order to calculate the charge.
Correct. Yes. Yeah.
And then every year it's escalated by Halifax CPI, no matter what your prediction was.
Correct. Yes. Correct. And that it goes along with the interest, the construction interest as well. So it's just a mix of those two. Thank you, Kevin. If we could go to the next slide, Megan. All right. So timing of collection. So that conversation between permit and meter install that was denied before. And we have the reasons for the denial, but what we want to show is that we do have the flexibility to change the model, to adapt to the financial model to each situation. And we could do that if things change in the future. Okay? So that is something that we can bring and make the model available to do that. And if you could go to the next slide, please, Megan. And so this is just an example, just combining everything that we saw in the past. Numbers here it could not be the real numbers, right? It's just a summary, an example here. So just showing how much we see, for example, taking the wastewater charge here. If we look at costs A and B, the interest that you see in the on the left, when you see the first slides that we had on the left, we got the portion where you see the project list that varies, so column or item, for example, D and E on that list. Those are things that come from that project list. So when we update the project, the benefit to existing customers would change. And those would change in here as well. So that is just a summary of a bigger table with the whole project list. Some things that we discussed earlier. So the items G and H, for example, the growth percentage, the employment growth percentage, things that we talked about in the first workshop. So those are the non-financial inputs that we have in the model as well. So these are listed here. And if you could go to the next slide as well. So that is a big calculation there. Just, yeah. So some other things that we saw in the previous workshops, the number of single units, residential units, population growth, projected employment rates, and everything else that we saw would come in here to give us the single units, multi-units, and the ICI per cubic meter rates. So that is the final calculation, which just showing getting everything from non-financial plus the financials that we showed earlier today, and we get those final rates. That's the whole output of this project.
And Peter has his hand up, I think maybe for the last slide, possibly.
Yeah, can you flip back to the previous slide? So is this the top line number there, the million, or that's 1.12 billion, is it?
Yes.
Yes.
Yeah. So presumably that's the total budget over the 20 years, is it? 20, 25 years?
For the next 20 years, yeah.
Pardon me?
For the next 20 years?
Yeah. So where is it discounted to get back to today's dollars?
It would be, today's dollars would be
These are-
column.
These are in today's dollars, my understanding.
Yeah. Because if we go back, if you go back to slide 5, please. Yeah. So we're looking at the top right there, the net escalated costs. Right. That would be if you go back. If you go back
So
to
Fabio, the starting point is the list in today's dollars,
in today's dollars. That's right.
in 2025 dollars.
Yeah.
It's not the future estimated cost. It's the cost of the project in
Correct.
today's dollars.
Current cost. Yeah.
So that's if you were to do all of the work today. That's
That's right.
today's cost?
That's the estimate of today's cost. Yep.
Okay.
And just remember that this is just a sample. That's not final numbers yet. Okay.
But going back, like, at some point, doesn't some discounting need to be done? You know, you're going forward, you're adding cost to that based on an inflation. Then normally there would be a discount rate to bring it back.
Yeah, the discount rate would usually be applied to bring it back to today's dollars. But if our costs are already in today's dollars,
We don't
That's
need to.
but
we
not
don't need to
all-
discount it.
that you. Well, that's assuming that the discount rate and the inflation rate are the same. Otherwise, they divorce. You know, if you're rolling things forward with the costs assumed to increase at 2.5%, and the discount rate is 3%, the math is different than using today's dollars.
Maybe, Peter, we can have this conversation offline. I'm not sure I'm fully understanding what you're
Yeah.
saying.
Well, I
But
know
happy to have the conversation.
in 2013 at the UARB hearing, I was shocked by, call it, the lack of, you know, when there was basically no discussion, or the discussion that was had regarding a discount rate, I left shaking my head in terms of, you know, how the numbers were being done. So I don't know why this needs to get moved offline when it's a very important item.
Yeah, and I think the other thing to keep in mind, the model that was used in 2013 wasn't as robust as this current model. And so this one, but we just want to clarify, I'd rather reference how this model is structured versus the 2013 model. I'm not saying that it doesn't take into consideration the concerns that you're raising, but I just want to almost kind of compare apples to apples if
Yeah.
that's possible. So
Yeah. So
Yeah.
what's the borrowing cost with the water utility now for, call it, long-term debt?
We're
Our
still
current
getting,
costs of borrowing, like our last debt issue,
Yes.
about 4.5%.
yeah.
Yeah. So I don't think it's appropriate to be using, today's dollars. I mean, you should be discounting it based on the cost of capital going forward. This is basic finance. You should be taking today's costs, taking them out by, whatever your assumed annual inflation is on the costs, and then discounting it back today because there's a difference between the inflation rate and the discount rate.
So if I'm understanding, we take our estimate of the cost today, push it forward to when we think the project's going to do, and then discount it back
Bring
by
it back.
our discount rate to get our estimate of the cost today.
You get a net present value today to say, okay, here's what we need to start collecting today.
Even though we have that estimate of what the cost is today, we
Right,
would
cost.
escalate it, we would move it forward and then bring it back to get back to our
yeah.
starting point.
Except you're not doing all the work today.
no,
If you-
and sorry, I don't know if there's a slide with the infrastructure table on it just by itself.
No, we do not. No,
No,
not
so,
here. No.
and I don't know if this helps the conversation or not, but the projects are determined in today's dollars. They get into the infrastructure list. And then we look at the year that they're going to be installed or constructed. And that's in 5-year increments. And so there are escalation factors, I believe, applied to those projects for when they get installed. And I don't know if that helps with some of the conversation on making sure that they're in the right year's dollars. But
why are you applying the escalation factors unless you're going to discount it back? Like if you're saying this is what the cost is today, I don't understand. I mean, do you have a big spreadsheet that's got,
yeah, so
600 lines
yeah,
of items, and then when they are, going out over the next 20 years?
yeah. I think,
Works,
Peter,
yeah.
if you look at the chat, I put the link to where the spreadsheet is. And I think that's where there might be benefit to Louis' point of having some of the conversation offline. And it's not to not have the conversation. It's just to have it with the fullness of being able to go in and out of the spreadsheet and look at how everything's structured and laid out. And I don't know how easily it is to maneuver that spreadsheet in this format. There, Megan brought it up.
Yeah,
But this is.
The link just goes to the general website.
No, if you go down below on the general website, there's a zip file.
It's under workshop number 1. The model
Sorry,
that that was approved as part of 9494 as an Excel sheet is posted there. It's a zip file, so there's a few more clicks involved. And that Excel file I now have up sharing as part of my screen on the wastewater infrastructure program.
Oh,
So where's the zip file? Like on the website there, is it the RDC finalized 9494?
Yes.
yeah.
So here we are at the engagement website. RDC finalized the model. It's a zip file. So you need to download, open the file, and then give it another double click, and that's an Excel sheet. That was directed, right off the URB website. So it's telling me I can't open two of the same, but that is the Excel file that's there that does show in detail how each one of those projects were escalated and how they're escalated the benefit to existing as part of that matter number. Is there anything in particular we want to go through as an example with this before we move on?
I'm just looking at the sheet. So yeah, just not clear on how the math is being done in terms of going back and forth between today and escalated costs. So like the number that was on the top of the sheet there, the $1 billion number, is it in this spreadsheet under the wastewater?
It may not be the same numbers you see that. Just using different files is just a summary, an example here, not necessarily the last M9494 file there.
So it's
So-
more about the methodology than the particular.
And
Yeah.
the particular
Exactly.
number, yeah, it's just showing the sample.
So where does one get that number for the total wastewater projects?
When we finish the whole update on the project list, capital list, we're gonna have those detailed, and you're gonna see just as Megan presented before, all the projects, and you're gonna see the link between the projects to those to that first line that you see on the table there. But that's just a summary of all the projects that you're gonna see when you have the completed project list.
Okay, but back to the question of how this math is being done with the projected time for them being completed and the costs being inflated. Is there anything that we can see to try to wrap our head around how the math is being done?
Not yet. It's not complete
Yes.
yet.
That's a pretty important item.
Yeah. I think the spreadsheet that's online is the best
Previous one.
spot to start, just to kind of see how the pieces
Mhm.
all are connected together. And this is a summary sheet that there's an actual tab in the spreadsheet that kind of shows that. The inputs to it are being updated with respect to the infrastructure program and the list. And so that top line of the 1.1 billion, that's going to change. And where staff are finalizing what that list is going to be. So the framework is what we're currently proposing to continue with, but want to get feedback on that. And the dollar values that you see on this slide are going to change because it's going to be informed by updated infrastructure list, updated populations, any changes in financing figures and that type of thing. So, but yeah, I think, is it adequate? Like if we go take the question concern away and try and formulate a response back to address the concerns about discounting, and if that's fair. And the other thing I want to remind everybody of, we still have a placeholder for next week reserved as kind of a backup time if we need additional conversation on certain things, or if we want to convene to go through some of the details a bit more in a group. So it's a placeholder that we have for an extra workshop if needed.
Yeah, I guess I'm just confused if the list is what they cost today. Why is there even a discussion about projecting the cost forward? on a per project basis. Because it wouldn't impact the math.
Yeah.
Do you see my point?
Yeah.
Yeah, bring it forward and back. Yeah.
So like this, the 1.126 billion, and I understand the list isn't finalized, but let's say that was the final list. Is that the sum of some projects? Like if something wasn't going to be done for 10 years
So
and
if you look
you're
at,
rolling it forward, is that 1.126 billion include a number from 10 years from now? Or is it all as if the project is being done today?
that is,
I'm not sure off the top of my head, Peter, but we can certainly dig
Evaluate
into
it
it and
better.
get back to you.
yeah.
Okay.
Because
right.
out of, yep.
I was going to say James has been patiently waiting with his hand up. So James, what question do you have?
I have a similar line of inquiry as Peter, but I've actually lost the screen, and I can wait and look at the spreadsheet and try and understand it better. But if you respond to Peter's in the over time, that will answer mine as well. I'm going to log out and log back in though.
Okay. All right. With that, what slide do you need me on, Fabio?
We can move on to the next one, which will be just the summary, the final, because we have the other ICI methodology presentation coming along shortly. So just a summary of what we saw today. So it's just we talked about the previous workshop, the assumptions for the RDC model, how we calculate the escalation factors, the timing of the charge, and showing just how those figures are discussed in workshops, the previous workshops tied together to the whole RDC numbers, right? So it's just combining every other workshop that we saw today, and we're looking at how those would affect the charts. And so as next steps, all your questions, please send it to RDC 2025 at Halifax Water. You will have this presentation saved on the folder we have. And in a short time, I think, I don't know if you gave 5 or 10 minutes, Megan, for the workshop number 4, where we're going to talk about the ICI methodology to start just in a few minutes.
So if I could have like 4 minutes, just to kind of set up the next slideshow, I will be back on at 1:55. All right, everyone. Just with that quick break, we are back. I just wanted to check with James. Did you have a question? Your hand's still up. I'm not sure if it was kind of a do-over from you going in and out. All right. Just wanted to check again, James. I see your mic is on. All right. And I guess with that, we will get started as some people are coming back from their break. that we have, so the second part of this workshop today is going to be the application of the charge. So part of this including the ICI methodology and of how the charge is applied. So again, this workshop is being recorded and will be posted on the RDC engagement website. So the agenda for the second half of this workshop is going to be a brief look back at how 9494 was calculated, and particularly how the employment assumptions were used in order to get the square footage charge for our RCI customers. And ICI is an acronym this presentation is going to be using a lot, and that stands for the industrial, commercial, and institutional uses. So basically everything that is not residential is put into that category. Once I go through a brief kind of introduction, well, a brief look back at the last 5 years, we'll go into an options discussion. And what we have for you is 4 options to discuss. One is looking at the existing application, possibly using the size of the water meter as it to charge the regional development charge, the number of fixtures, and taking a quick look into those residential equivalent units. So with that, I bring you back to the RDC model that was used in 94-94 and back to the first tab of the population projections that we see down here. In order to calculate the employment growth for the regional development charge, there's a couple important columns here. We have the residential growth, the employment growth equivalent area, and then down here we have a couple of assumptions. So the first step in order to calculate how much employment growth we have in terms of equivalent area is to use the residential growth in our 5-year increments, and we multiply this by 58.16%. And this is the employment population equivalent. It's something that was derived in 94-94 in H24. From there, we get employment growth as a population equivalent. From there, that population equivalent is multiplied by 809 employee, and this is the employment density floor space per worker population equivalent. And then we have the employment growth in terms of equivalent area. This area is then inputted into the model to calculate the charge. Yes, it is square feet. We deal with metric. It is a metric, a meter square that is charged. Just for the purposes of this model, we're speaking in square feet. Back to the 809 in terms of the employment density floor space per worker, that was calculated using 781 employment density floor space per worker, dividing it by 0.965, which is the population equivalent to 1 employee. That 781 with further a blended average that was developed through 94-94 in undertaking U3. So it used a blended average of different municipalities that you can see there, and you can go into undertaking number 3 if you would like to know more information. So with that, we have the employment growth that we're forecasting. And here we are 5 years later from 94-94. And let's take a quick look back at the last 5 years of what we calculated and what we actually collected. So we have a chart on the screen. The bottom is the time starting in April 1st of 2020. So this is the cumulative average started in April 1st. So that's where we start at our year 0. ICI space is 0. And then on the y-axis, we have the new ICI area in feet squared. So the orange line is what was forecasted in the model of 94-94. And then the blue line is the actuals. And this is based on new water permit data when submitted. So it does include like small changes or refunds, but it is data that we got from HRM, from the open source data that shows that we collected in terms of square feet less than what was forecasted. And of course, this last year here is where we currently are. I think I showed these numbers before in the population workshop, so we're not done this fiscal year yet. But when we look at the 2020 sorry, the 2023 and 2024, we see that it is consistently less than what was forecast. So with that, so are there any questions or points of clarification through that brief introduction of how it was calculated for 94-94? I see, James, you have your hand up.
I don't know if his hand came down from the last session, Megan,
Okay.
possibly.
All right. So with that, yep, I will keep going with it. And for sure, if there's any other questions that come up, really quickly switch back to the slides. So with that, we get into, as part of 94-94, there was an action for Halifax Water to investigate new cost application methods. Then when we look at a new cost allocation method, there's a couple of things that we need. One of them is, is it generally easy to explain to the public? Do we have the data to forecast how this methodology is derived? And can we forecast it as part of a 20-year model? In order to go at, so as we go through these 4 options, I'm going to first explain the option. I'm going to then go into the advantages and disadvantages of the proceed option, and then we're looking for discussion after. Maybe some of the disadvantages that are there, you can help provide more information or like data to support forecasting in order to kind of move that disadvantage off that list. So again, we have 4 to discuss. The order will be, the option will be explained. We'll go through advantages and disadvantages, and then we're looking for discussions. On a side note, Halifax Water has not decided which one of these options to go. We're really looking for feedback from the interesting parties of each of these options to listen and to consider and to help us make the best decision possible based on your feedback. So off we go to option number 1. And that is the current application. So as you know, there are 3 RDC rates, one for single unit dwellings, another for multi-unit dwellings, and then one for everything else that isn't residential that we call kind of the ICI and is based on the area. These numbers are calculated they're calculated from forecast populations, and they use a lot of averages and assumptions that our municipalities' planning data helps us forecast. So let's take a look at some of the advantages and disadvantages of the current application of the current charge. So big advantage with this current application is that it's a very familiar method that is already built into the permitting portal. As you know, municipality has a new, everything submitted online. All this information is easily inputted and it's very familiar. This application is forecasted through population estimates. And another advantage to using this method is that as you know, demolished buildings with no immediate plans for redevelopments do not result in an RDC refund being done. However, when we look at the net increase in residential units, it's a very simple calculation to see how many, what was there before and what you're proposing to do next. Again, RDC is based on the net increase. Say you had a 50-unit building on the site, you demolish it and then build a 200-unit building, you get credit for those 50 units. And then again, a big advantage with the current application is that if there's and this is just for ICI buildings with no building additions, but if you have an ICI space and the building use changes, whether it be a tenant or a new building owner, this does not require a recalculation of the RDC. The ICI RDC was paid for at the time of building application. What tenant goes in, what tenant comes out, it doesn't matter as long as it says ICI. A little bit different case when if you change a commercial building into residential, and those are dealt with on a case-by-case basis. But a big advantage to this is that any type of ICI change order tenant, as long as it remains ICI without any building additions, there's no RDC calculation with that. And then so with that, we have the disadvantages. And like the major disadvantage with the current application is that there's a vast range of demand for ICI, so non-residential customers. And there's only one category for them. And if we take it like an example of the warehouse and the laundromat, we have the laundromat that uses a lot of water in the warehouse that doesn't. They're both paying the same RDC rate, but one is using vastly more than the other. Now, true, the water rates are vastly different and they pay for what they use, and that laundromat could turn into a brewery or a warehouse, as the warehouse could turn into a brewery in that sense. So with that, is there any questions for clarification? Could anyone provide any more disadvantages in terms of this current application? Opening up the floor to everyone. Yes, Peter.
But if a warehouse turned into a brewery, wouldn't there be a round two in terms of collection of fees at the building permit stage?
Currently, there isn't. The new building's built. It has a service connection. It has a meter. It has the number of fixtures. So if it's built with one washroom and then there's a renovation to it, and they don't have any additional like building additions, to turn that warehouse into a brewery, there's no additional RDC fees. There may be additional meter sizes and like a meter increase with a higher demand and kind of rechecking the BFP for different risks associated with it. But as the current method stands right now, a warehouse could turn into a brewery and there wouldn't be a change in the RDC.
Yeah, so the basis of this format or the way this is set up, it's looking at average use of a large range of ICI values and uses. It gives the developer, the building owner, some flexibility. So if you build a leasehold, you pay your RDC, and you have different units come in and out with different uses, you don't have to come back and reconcile RDC charges with us or anything like that. It's done. The only time that there's a reconciliation or differential charge occurred is if you change the footprint or add on to it. And so one of the main advantages of this is you do pay up front, you pay it, and then if you don't change the footprint or if it's a residential, multi-unit residential, if it's the number of units, there is no need to kind of reconcile your RDC charge. So, but that too comes with disadvantages, given the example that Megan gave on the warehouse versus the laundromat. So that's why we want to chat through, get some feedback, and we can run through all four, and then we can go back and you can kind of weigh in on what makes sense, what you like, what you don't like. So, but I see Mark's got his hand up.
And you're also on mute, Mark.
Not anymore. There.
Okay.
So that advantage, warehouse versus brewery versus other ones, it is a huge disadvantage. And, most of Burnside is straight up warehouse with very little water use. And you're not the building sizes are actually inversely proportional to meter size. Like you have a brewery or a distillery are usually a smaller building than a great big vast warehouse. And yet the warehouse ends up paying a disproportionate high amount for the RDC over a brewery. So like their costs are inversely proportional relative to the building size and the water use. So that's a big main disadvantage of this. And I have to face it to clients on a constant basis, like that they don't understand it. They're paying for a 400,000 square foot building with 2 washrooms, and that's it, right? So,
Yeah. And there is a layer there too, that the warehouses will generate potentially a higher fire flow requirement as well. So not always visible from a direct benefit or direct use, because it's not something that you're using every day, but the infrastructure needs to go in to be able to facilitate that volume. So, but yeah, and those are the prime, what you just kind of outlined seems to be kind of that prime disadvantage that we've heard over the years.
but the category of the building too, whether they're an F high hazard, which most warehouses aren't, but manufacturing and distilleries, et cetera, that use more
Right.
water are. So they end up using more water for that as well, even for fire demand. So.
And I'm going to take the opportunity to put in the shameless plug for our wastewater rebate program. So if you have a brewery and you're drawing a lot of water and sending a reduced amount of wastewater to the system, you are eligible to apply for a wastewater rebate. So if you don't know, see me after the meeting.
And we have done that in our concrete plants.
Yes, yes.
We take lots of water in, but it all goes out in concrete. So.
Right.
All right. So with that, again, this is not the end of the discussion of option 1. I'm going to move on now to option 2, which is the size of the water meter. So every water customer has a water meter in Halifax Water, and we have a little picture there. And then the RDC could be charged based on the water meter size, which is a calculation based on the use, pressure, number, and types of fixtures. And as you can see from here, there are about 11 categories of different meter sizes that are there. So when we look at meter size and some of the advantages with using a meter size as an indicator for an RDC charge, upsizing the water meter or even installing the water meter will depend solely on Halifax Water, and it will depend on a Halifax Water permit coming to us. You can't call up a customer service and ask for a meter. It has to go through the engineering approval side of things. The next advantage is that there is a range of sizes, and it's approximately 11. So right now we have 3 categories for the regional development charge. A water meter could expand that to 11 sizes. And then with the water meter, the charge is based on the potential capacity of that water meter. So you're being charged for how much water you could get through that water meter, kind of bringing the equality down to the brewery and the laundromat. They're going to have different sizes of meters. So disadvantages to taking a look at that. There's a lot of inequality with smaller water meters. So bringing the size of the water meters, to single unit dwellings and multi-unit dwelling houses along with ICI, there's a big inequality with the smallest meter size, which is a 15 mil. Speaking in metric, which could handle a single unit dwelling or could handle a 4-unit dwelling, depending on pressure and flow that way. And as you can imagine, right now, there is a large cost difference with a single unit dwelling and a multi-unit dwelling. The next disadvantage with this is that building owners may not upsize their water meter for their tenants. There's a lot of gentle density happening in Halifax, and sometimes that 15 millimeter might be a 19 millimeter in order to get better pressure and flow for all those tenants. So if there's a large cost to that upgrade, that is a decision for building owners to make. The next is that wastewater only customers, and there are a few, would still need a fixed rate that would have to be worked through in order to determine their regional development charge. The next disadvantages after that is that existing customers that have already paid RDC that may complete future renovations. So as you know, the charge has been around for the last 10 years. How do we treat those customers that have paid the ICI at an average rate and now they want to, that warehouse wants to turn into a brewery now and it needs a larger meter? How do we go through and apply the new method for those for those situations. And the last disadvantage with this one is that it's difficult to forecast long term. We do have people, we have employment assumptions, and then we have to put those assumptions into a forecast in terms of the size of the water meter. That is difficult to forecast, and we welcome your feedback on the size of the water meter as for the regional development charge. Is there anyone that thinks that some of these disadvantages could be taken off? Yes, Peter.
So
We're on mute. Okay.
yeah, I'm just a bit confused. Is this discussion solely about the ICI side?
Water,
Or is
I
this
have
supposed to
both.
be doing for ICI and residential?
Let's talk about both.
Okay. Yeah, I'll wait till you finish
Yeah.
before I weigh in.
So the board ordered us to look predominantly at the ICI, but we also, there was discussions in one of the earlier sessions about some of the factors that go into the SUD and the MUD numbers with respect to people per unit and those types of things. So as we kind of talk about getting to an REU, which is one of the other options, we have to kind of set the stage for how some of the charges are collected right now and some of the framework. So basically, any of these are on the table for discussion, the residential, non-residential, but we just want to kind of walk through some pros and cons with a lot of the focus on the ICI because of the direction from the board. So just giving some context to that. So.
And I think if we we take the single unit dwelling and multi-unit off the table, then it's like some of these disadvantages kind of that can come off in terms of the smaller water meter sizes and kind of the building owners not upsizing for tenants. So yeah, we're open to discuss everything. And with that, we have Mark. And Mark, you are mute.
There we go. Sorry. What you notice about the existing customers that have already paid the RDC, if you switch to a meter size and then someone is switching from warehouse to a brewery and they have to up their meter, or even vice versa, if you go with what was their meter and you give them a discount one way or the other, if they're not using as much water and now they're going to use more water, it would help to equalize some of the inequities that existed beforehand. So it's actually an advantage, I would think, more than a disadvantage.
Okay. Just thinking about that, but yeah, to put it, so how, I don't know what I'm going to say. I'm leave it that. Sorry,
I mean, if you had an RDC for whatever we call it, it was say $1 for a 1-inch meter and $2 for a 2-inch meter, and you needed to switch from, because you just had a warehouse and all you needed was a 1-inch, and now you're doing a brewery and you need a 2-inch. Well, then you got to pay that extra $1 to make that conversion. And vice versa, if you said, okay, I no longer need that water because the brewery's going under, and so I'm going to switch back to a 1-inch meter, then I get a refund.
And I think the example Megan's given is if that warehouse was built since the RDC came into place, and they paid they paid charges based on the old methodology. It's coming up with that equitable, transparent conversion to make sure that you're not double paying and trying to, do we owe you a refund? Because even though you're going from a warehouse to a brewery and you paid that 2-inch under the new methodology, is the math different? And it's just kind of trying to figure out that the reconciliation of have you already paid? What methodology did you get charged under? And is there that conversion between the two that we can, I think that's where that disadvantage was going to, Megan, if you can
Yes,
correct me.
exactly.
Yeah.
Yeah,
it's
no,
all
I
doable.
understood that, but
Yeah.
I'm thinking that it may, even though you did pay already,
Right.
that it would help to, if you, yeah. I'm not sure, and that it might balance it out.
Right.
That you're able to get some money back by doing that, but
Yeah.
maybe
Yeah.
not.
And that kind of comes in from like the demolitions of when an existing customer like demolishes their building, we don't give a refund for that. Yeah, the refund really comes in the net increase once that site is redeveloped. So looking at that methodology and applying it to the water meter in this case, there's some difficulties like in forecasting that. That would have to be worked out to and looked at in detail. All right. Oh, James, you were up next.
Yes, thanks, Megan. Can you hear me?
Yes.
Okay. Going back to Kenda's comment about the board's direction, I've gone back to that decision in 09494. I have not gone back to all of the undertakings, so I may not be completely accurate, but in the decision, there's clear direction to Halifax Water. And I'm quoting, over the next 5-year RDC cycle to develop a new ICI RDC methodology. This new methodology shall be based on the REU approach and should follow the guidelines in AWWA Manual M1.
Mm-hmm.
Now, is that not what is operative in terms of direction to Halifax Water? Was that somehow updated in the undertakings?
No.
Or do you not agree with that and you're looking at a broader array of options?
So, yeah, so good point. And I think it's option 4, Megan.
Yes.
3. Yeah. So there's 2 more options coming in the slide deck. One of the things we wanted to do for the wholesome engagement with the impacted parties is get feedback on a number of different scenarios on how do we collect the charge. And during the hearing, one of the concerns that we raised was looking at a different methodology for the ICI rate, and the people that customer base of ours that is paying the charge wasn't part of the hearing and couldn't add value to the different methodologies. So in looking at the REU methodology, we also, in talking with our consultant on this, were presented with, here's a couple of other scenarios or couple other options to do this. And so we wanted to present all 4 of those today and get feedback from the development community on what do you like and dislike about all of them, and then present that in our filing to the board as, yes, agreed. You asked us to go and look at the REU. Here's what we found. And oh, by the way, here's pros and cons for a couple of other scenarios. Here's feedback from the development community and that type of thing. So it's more just to kind of set the stage for what options exist.
So just a quick follow-up. So you're planning, I mean, it's a little confusing because there is clear direction for one methodology, and you will present that, and I
Yes.
appreciate that. I have to leave this call early, so I did want to get in before I have to go. But you're presenting the pros and cons of the others in case you want to petition the board to change that decision and that direction to Halifax Water, and you may want to, in fact, go with an alternative approach. Am I reading too much into this, or is that more or less Halifax Water's position?
So I think we just want to, we appreciate and respect that the direction from the board was to come back with an REU scenario. And we will present that. We also are mindful that the development community may want to have feedback or input into that. So we want to kind of walk through, here's current state, here's what everybody knows and understands. Let's talk about what you like and dislike about it. And then I believe during the hearing as well, meters were discussed. And forgive me, Megan, what's on option 3?
Fixtures.
Fixtures were discussed. So again, we're going to go in with, here's what REUs look like. And I don't know what the development community is going to think of REUs. So I want to get input from them. And then I want to have other options available should we need to talk about that through the process.
Okay, thank you.
Right, Peter. And you were on mute.
Yep, thanks. As much as I would like to debate how this is done on the commercial sector, because I think it's unnecessarily complicated. I'm not active in the commercial sector. So those people that are affected, other than Mark is here, they're not here as part of this discussion. So to me, that's their problem. So I'm going to circle back to our industry, which is the multifamily residential, and the business with the way the math is done and the assumed number of people in the units versus the actual. Does that fall under the purview of reviewing this? Because if you do the mathematical example of assumed number versus actual, the difference between those as a percentage will result in an overcollection of the RDC. And so that's where I want to focus my energy, is trying to get that, call it, per suite allocation fixed.
Yeah, and I think some of that was touched on, I think, in presentation workshop 1. And that's a commitment to go back and look at those assumptions that go into that ratio that you've raised about the SUD, MUD. And so that conversation's not over. We just don't have that in this slide deck for getting some feedback on the ICI stuff. So certainly prepared and willing to have more dialogue on that. And we, I think, need to have a chat too with HRM on ratios and populations. And then we have some information that you've shared on that we have to pull together on units and density and that type of thing. So there's still a bit of work to do on that, but that conversation's not over.
Like it would seem to me that if a person knows, say over the last 10 years, how many single family homes have been built and how many apartments have been built, and you've got the population, at the start and stop of that 10-year period, a person can actually do that math. Like to look at a static number of there's X number of people in an average residential unit in Halifax is meaningless. You need to look at what the trend is, say in the last 10 years, to determine what the incremental number of people is per unit. And I would think that information would be relatively easily available.
Yeah, and I think
certainly
Megan,
the permit stuff definitely is. The population stuff, in over a 10-year period, can you figure out what the population has changed in the serviced areas off HRM?
Yeah, and I think there's a lot of that data that's in the first workshop slide deck on units, ratios to units, people.
It didn't do it on an incremental basis. I believe that it did it on a, as of today, there's 2.2 people in an average residential unit in the HRM serviced area. And I'm not disputing that. Okay, that's a data point.
Mhm.
But we also need to look at, what was there 10 years ago
Mhm.
and how many permits have been issued in between,
Yep,
so
we
that a
have
person,
that.
so that
Yep.
you can reverse engineer it to actually figure out how many, because you can't, you're not going to be able to get statistical data from, call it StatsCan, on what the incremental is in the new construction, but you can deduce it by looking at what was the population then, what's the population now, how many permits were issued between, and you can figure out what the incremental number is per household, mixed between apartments and
Mhm.
houses. But say on the peninsula, effectively, there's no new houses, right? So you can come up with something fairly close that would be more indicative of the number of people in an apartment unit than the HRM 2.25 that I believe was created in approximately 1969
Yeah, and
when
that's
planning
where,
came
yeah,
in.
yeah. So we want to go back. We haven't done the math yet, but we
And
want to
it,
take, yeah.
and it's on the follow-up slide that, the first slide, well, the first or second is that it is a follow-up, item, people per unit, kind of bringing in that data. We haven't had a chance to look into the details of that information, but we do hear you that it's something to look at, and that, for the regional development charge, whereas your interest in the size of the water meter, may not be there as what an ICI customer would be.
Okay, so when will that, when's the filing going to be done with the UARB?
Our date to file is March 31st. So we do have a lot of work to do before then. And as we get more information, we want to reach back and make sure that people have the current data available to them to review.
Okay.
All right, James?
Just a quick follow-up. So you're filing March 31, even though the RDC is frozen through October. So I'm a little confused by that. Can you clarify?
Yep, certainly. So when we received the decision on the 2019 filing, we were given a date to refile October 2025. And as most of you know, we do annual updates for CPI in April. And then we do what we refer to as that plus minus 15% review in June and file that with the Utility Review Board. So we notified the Utility Review Board this past April that because of the freeze, the CPI adjustment did not happen. And then we did the plus minus 15% filing in June. And with the addition of the water supply enhancement project, the math came out that the charge would go up 76 or 78% for water. So we filed that with the Utility Review Board. With the decision that we received from the Utility Review Board in July, I think, they instructed us to file in March 2025 versus October. I
Yes.
believe that was with the intention that a hearing would be over, a decision would be rendered in and around the time the freeze would come off from the province.
Okay.
That's
Yeah.
my suspicion.
Okay, yeah, that makes
So-
sense. Thank you for that clarification. Yep.
All right. With that, we'll move on to option number 3, which is the number of fixtures. The RDC could be based on the number of fixtures that are put into a house. Fixtures are things such as your tub, hot water heaters, different places where water comes out of. This information is collected for new buildings. We have an example of Form DM1. And when we look at the advantages and disadvantages, a very big advantage with doing the RDC based on the number of fixtures is that we have a greater differential in the fees rather than just the 11 categories for the water meter. This information is available in new water and building permits, information we already asked for that is given to us by the developer's engineer. And next, in terms of like renovations, if you're going to turn the warehouse into that brewery and need a few extra fixtures, we would likely review the initial renovation permit. So with that, some of the disadvantages of using this method is that a more detailed information is required for the amount of fixtures to do that count during the review. And I would even say there would have to be a reconciliation with that permit review count and then what is actually built. As you know, issue for construction drawings and what is actually built are not two different things, but there are changes that occur through the construction process. So there's a big disadvantage. There's a lot more review time on Halifax Water side in order to gain that information. The next, we already have those existing customers that have already paid the RDC based on the rate that we have now. There's no mechanism to account for the reduction of the fixtures going back to the how it's originally applied. We don't give RDC back for any demolitions. That comes in for the net increase when that building lot comes in for redevelopment. Renovation permits that change after the initial view may be missed by Halifax Water. Things change as things go through the process. So, a renovation permit that was just a porch and then it could change into like a major upgrade to the services may be missed in that process, but there's always room for improvement there. And then when we look at calculation of the net increase in fixtures for permits with demolitions, this almost becomes unmanageable. When we look at net increases, like now we can go to Google Earth, we can go to Google Maps, we can see what the building was, you can see what civic numbers are attached to it to make an estimate of like how much area is there based on like aerial photography. If we had to do it by the number of fixtures, this would be very difficult to determine because I know there's not a reconciliation process when a building's demolished, someone's going in there and counting. So that would have to be worked through. And again, it's difficult to forecast how many fixtures that would occur over the next 20 years in order to set that charge. So with that, is there any clarification or questions about using the number of fixtures as the RDC? Yes, we have James.
No, I'm sorry. I have to take it down.
Okay, sorry. All right. And again, we can always come back to it, just presenting these advantages and disadvantages. With that, so I'll move on to option number 4, which is a review of the residential equivalent units. So residential equivalent units, this is a unit of measurement which consists of the amount of normal water/wastewater contribution from a single residential unit. So for example, and this is an example, I just kind of made these numbers up to be simple, one residential unit, we're going to say 1,000 liters per day. We have a new permit that comes in and they say they use 10,000 liters per day. We divide it by that, the 1,000. So they are equal to 10 residential REUs, residential equivalent units. So as you know, property and the use of the property is an indicator of how much wastewater and water is needed. This is done by Halifax land use bylaws. There's multiple categories with each land use bylaw. And here we have the water and wastewater from an office to a cafe to a hair salon is very different and can change. And I know we talked about fixtures and water meters as an indicator for how much water is being used. Relating this back to a residential equivalent unit, requires assumptions and understanding of what the space is going to be and to use. So again, a very high level look at residential equivalent units. And that when we look at the application of them, the advantages and the disadvantages. So an advantage is that it provides a differential in fees that it outweighs the number of meters that we have, like meter types that we have, which is around 11, the current method, which we have the 3 categories, and generally like the use of a building is known in terms of like the industrial, commercial, or institutional kind of category. However, when we look at the disadvantages in order to calculate those residential equivalent units, that specific tenant information is often unknown at the time of the building permit / water meter. As the building is being built, the owners may not have tenants yet. So in order to calculate whether it's a salon or a coffee shop or a brewery, sometimes that information isn't known. If with the residential units related back to the specific use, this could mean Halifax Water needs to be included as part of the occupancy permit review. Halifax Water isn't part of that review right now, but if it goes from a restaurant to a salon or like a restaurant to a brewery, just in terms of a movement of a tenant, that is a new process for Halifax Water to be involved with and to review. Another disadvantage is it could be difficult to forecast the diverse uses. No mechanism to account for the reduction, and this is for those existing customers. Calculation of the net increase in REUs for permits with demolitions is difficult. I think it's easier than the fixtures kind of count, but Google Maps doesn't go every year. We might not necessarily know what a use was at any given time. And then like the last disadvantage is the residential equivalent units leading to more of a tenant fee versus owner fee. So right now the RDCs are charged by the owner or the builder when it is built, but say they come in for a higher REU use, does that fee now become on the tenants, and that when they leave in 5 years, do they get a discount? Like, do they get the money back? So there's a lot of things to work out in terms of the tenant and the owner fee. So with that, I know that's a very high level look at the residential equivalent units. I open it up to everyone to kind of provide more clarity. What am I missing? How can we approve? Do we like this method? Yes, Mark.
It seems to me they're basically all the same thing. I mean, we use fixture counts to determine our peak water use, to determine our meter size, and you try to do that as efficiently as possible so you're not wasting water. So if you want to be sloppy and get a bigger meter, then you just end up paying more, and it's as simple as that. And it's very easy to calculate. And in the future, if you need to use more water and do renovations, then you end up paying for the upsizing, an RDC for the upsizing of your meter. And then maybe it's a combination between that, the meter size, but then also the sprinkler lateral size based on square footage, or how big of a fire demand do you need? That needs to go into that for ICIs. It needs to be part of the calculation. Definitely needs to be. And if you want to relate that back to REUs in some way, but meter size seems to be the most efficient and an equitable way of doing it, I think.
And it all kind of like comes back to the meter size, like fixture.
Yeah, it's all it's all more of the same thing.
Yep, and thank you for the fire flow. Like that's something that wasn't really touched upon in any of the advantages or disadvantages with that to
I didn't
calculate.
want to, but Kenda brought it up. So
Okay. Um, with that aspect.
that's it.
Anyone else? All right, without seeing any hands, I'm going to move on to the last slide. And again, the conversation isn't over about this. If you do have questions, please email RDC at 2020 RDC at 2025 at halifaxwater.ca. Are there any other options to consider for RDC calculation and how to implement and apply the charge that wasn't covered? Yes, Peter. Oh,
Okay, I thought it was a general question regarding the RDC, not uh, related to this math. So I would like to circle back to that at the end.
okay. Just see, is there any question, like other methods about like to calculate RDC with that? Because if there isn't, I can take I can let you know that, of course, like we have our website, we have our email address, and then we have workshop number 5 is additional requirement. And I can send out that invite. It would be more of a question and answer kind of period. So if you have any like questions, please let me know so I can start an agenda with that. It's something, we don't have to have it as 3 hours. We can have it like closer to 2 or like an hour and extra time like that. So without seeing any other hands with that, Peter, I can take your question.
Sure. At one point on one of the previous sessions, it was indicated that there was no work contemplated in terms of a demand side management analysis. Is that the case?
For this RDC, like what's due immediately, no, demand side management is not included. However, it is being worked on outside of this process.
Yeah, so we do have, and I don't know if there's anybody on the asset management team that can speak to the status of that study, but we do have a demand side management study being worked on. And in the last RDC, we did set the regulations up such that if capacity can be gained and for development through a demand side management project, RDC money could be used to fund that project. And so we just wanted to have that flexibility. Similar in the last RDC update, we added in the ability to spend RDC money on inflow and infiltration projects that would gain capacity in the wastewater system for development. And so we've used a couple of those over the years to gain capacity in systems like the peninsula and that type of thing. So we just don't have a full program kind of outlined and actual discrete projects that we can point to.
Yeah, but I guess that part of the work that you're doing, that's, to me, that's only a part of the discussion, a small part. I'm talking about trying to actually reduce the demand by taking active steps and, modeling that into the future infrastructure required based on programs that could reduce the demand.
Right.
And I guess I don't understand, why that isn't being done as part of this current application.
I think the short answer is just resource constraints on getting that information pulled together. And I don't want to maybe put Marcia on the spot, but I'm going to throw it out there. In the current integrated resource project that is being proposed, I don't know if there's any tie-ins from the demand side management perspective into that program, should we get approval for that.
I would say there is definitely a link to the IRP, but we're also preparing an RFP to develop a water efficiency strategy. But like you were saying, we're a long way from having a program that can inform the RDC. So we are working on it, but it won't be able to inform this update.
Yeah, and I guess that was the same response 10 years ago, 12, 13 years ago. So as somebody who pays hundreds of thousands of dollars in these fees, I guess I don't understand. Why? I did the math and I gave it to Jamie, 13 years ago, recrunching the numbers as best I could, and changing toilets, I think would create infrastructure capacity for roughly a sixth or an eighth the cost of building new.
Yeah. So go ahead.
Yeah, I just don't understand. It's not like we're putting a man on the moon to work through that.
Right. And we sorry, I lost my train of thought. We did reevaluate the design flows that were being used to size the infrastructure. And those were reduced on both sides, which would directly reduce the size of some of the pipe sizes and that type of thing, and also reduce the costs. That's one thing that has evolved over the 10 years. The other thing, we did reach out to a couple of other municipalities that had programs to replace toilets and fixtures. And the input that we received from them was they were stopping their programs because I think the benefit was realized just by virtue of new construction was always using the new toilets, and people have renovated their homes over the years and they weren't seeing any realized benefit from a program like that. It's not to say that that's completely off the table coming out of our water efficiency review, but it did get reviewed at a high level, but not to the degree that it could inform a program that we could implement. So.
All right. Are there any further questions? With that, seeing none, sorry, Kevin Gray.
Hey, Megan. Just a little off topic, and you might have covered it in one of the other sessions that I didn't attend, but the upcoming infrastructure list. I'm just wondering if a calculation for each project for how the benefit to the existing customer will be provided.
That's a good question. So the list is forthcoming. Do you think it would help if we had like a column that said what method was used to calculate the benefit to existing as it relates to the position paper? Would that clarify?
Yeah, I think because every project is like, you have different types of projects and you're going to use different methods.
Mm-hmm.
And I think seeing that calculation or be able to look at it and understand it will be a benefit, because what we talked about today is basically we're just divvying up the pie. I think a more important question is how is the pie calculated?
Like how the growth piece comes from the infrastructure.
Well, yeah, to understand the benefit to growth and understand the benefit to the existing customers, which would be paid for capitally. Yeah, because like what we talked about today is, it doesn't really impact the amount of dollars collected. It just impacts who it's collected from. I'm curious to see like how the charge is built from a infrastructure perspective. So.
Yes. So that, yes,
Yeah.
that information is forthcoming, and before we send it, we'll look at it through that lens of
Perfect.
this is exactly the method.
Yeah, it was workshop 2, Kevin.
Yep.
There was just a bit of an overview of that, but the details are still coming.
Yeah. Perfect.
All right. I guess with that, if there's no more questions, we can end this workshop and look forward to the next one, which is kind of the low-key question and answer. If you have any more topics, please email me at rdc2025@halifaxwater.ca, and we'll go from there. All right. So with saying that, this is the end of the workshop, and we'll see thank you everyone for your comments and contributions to this, and we'll see you next time.
Excellent. Thank you, everybody.